Okay, welcome back to the deep dive. Today, we are plunging into the fascinating world of business finance.
Yeah, we're moving on to part 3, looking at financial documents from Unit 3, Business Finance.
And we're really zeroing in today, getting into Chapter 30. That's all about the statement of financial position.
It sounds formal, but it's a really crucial document.
Absolutely. Think of it like a financial photograph. Our aim today is to, really unpack it, figure out what it's made of, what the numbers mean.
And crucially, what it tells you about a business's condition, its health, its structure, but only at one specific moment. That's key.
That is key. It's essential stuff if you want to understand how companies work financially. And just a quick note up front, you can find loads more resources on this and other topics too over at www.igce-business.weebly.com.
Definitely worth checking out. So let's start right at the beginning. What exactly is this statement of financial position?
Good question. The name gives a hint, right? Financial position.
It does. It's a summary of a firm's financial standing. But the most important part, the bit you absolutely have to remember, is at a particular point in time.
Ah, right. So unlike, say, an income statement that covers a whole year or maybe a quarter,
Exactly.
this is like freezing time. You take a snapshot on one specific day, say December 31st. Everything the business owns, everything it owes, and the owner's stake, all captured at that instant.
Precisely that. A single moment in time. And it's always structured around 3 core elements: assets, liabilities, and capital, or sometimes called equity.
Okay, let's break those down. Assets, that's the stuff the business owns, yeah. Resources it controls.
That's it. Items of value. Things a business has that are expected to bring some future benefit. Could be physical stuff, buildings, machines, inventory, stock.
Right.
Or it could be money in the bank, cash. Or even money that customers owe to the business. That's called trade receivables.
Okay, so all the valuable things.
Right.
What about the flip side? Liabilities.
Liabilities are what the business owes to others. Obligations, debts.
So money owed to suppliers. Bank loans.
Yep, exactly. Money owed for supplies, bought on credit, that's trade payables.
Yeah.
Bank loans, overdrafts, maybe even taxes owed to the government. It's all the company's debt.
Got it. Owns versus owes. And the third piece was capital.
Capital, or often shareholders' equity if it's a limited company. This is basically the owner's investment in the business.
The money they put in.
That, yes. But also any profits the business has made over time that haven't been paid out to the owners but kept inside the business, that's called retained profit. It's essentially what the business owes back to its owners, or their claim on the assets once all the debts are paid.
And you said these three things: assets, liabilities, capital. They're always linked. There's an equation.
There is. And it's the absolute foundation of this statement. It's always assets, liabilities, plus capital.
Okay. Assets, liabilities, plus capital.
It has to balance. Always. And it tells you something fundamental, that everything the business owns, its assets, had to be paid for somehow, either by borrowing money, the liabilities.
Or by the owners putting money in the capital.
Exactly. It shows how the assets are financed.
So like the example in the material. If assets are, say, US $5 million and liabilities are US $2.4 million.
Then the capital must be US $2.6 million. Because 5 million has to equal 2.4 million plus 2.6 million. It just shows where the money came from for those assets.
Right, it has to balance out. Okay, so that's the big picture. But the actual statement gets more detailed, doesn't it? It breaks these categories down further.
It does. Let's use that Dingwall Building Supplies example from the source material. It lays it out quite clearly. We start with assets.
Okay, assets.
And assets themselves are split, usually into 2 types, based on how long they stick around and how easily they turn into cash.
First step.
Non-current assets.
Non-current. So these are the long-term ones, the ones that the business uses for more than a year, like the foundations of the business.
Precisely. In the Dingwall example, under non-current assets, you see property at US $340,000. That's their buildings. Land, maybe.
Makes sense for a building supplier.
Totally. And fixtures and fittings at US $100,000. That could be shelving, counters, office stuff. Add them up. And Dingwall's non-current assets total US $440,000. These aren't things they plan to sell off quickly, they use them.
Okay. Long-term stuff. Then the other type must be
Current assets, these are the short-term ones.
expected to be used up or turned into cash within a year.
That's the idea. The key word here is liquidity. How quickly can you get cash for it?
And cash itself is obviously the most liquid.
Right at the top of the list for liquidity. So for Dingwall, their current assets include inventories. That's their stock of supplies valued at US $150,000.
Okay.
Then trade receivables, money owed to them by customers, that's U.S. $78,000. And finally, good old cash, U.S. $56,000. Add those together, and Dingwall has U.S. $284,000 in current assets.
So you've got your non-current assets, your current assets. That covers the owns part. Now let's look at the owes part, the liabilities.
Right. And just like assets, liabilities are split based on timing. When do they need to be paid back? First, we have current liabilities.
Current, so short-term debts, due within 12 months.
Exactly. These are the bills breathing down your neck, so to speak. For Dingwall, the example shows trade payables. That's money Dingwall owes to its suppliers. U.S. $112,000.
Okay.
Then there's taxation, U.S. $12,000 owed to the tax authorities, and a category listed as short-term loans and overdrafts, totaling U.S. $124,000. Add all those up, Dingwall's total current liabilities are U.S. $248,000. These are debts they need cash for relatively soon.
And if there are current liabilities, there must be.
Non-current liabilities, the long-term debts,
Yeah.
obligations due after more than 1 year.
Like a mortgage.
That's the classic example, and it's what Dingwall has here. A mortgage listed at U.S. $60,000, likely borrowed to help buy the property, and it'll be paid back over many years. A long-term commitment.
Okay, so we have total assets, current plus non-current, and total liabilities, current plus non-current. The difference between those totals is significant, isn't it?
Very significant. That difference is called net assets. You calculate it simply. Total assets minus total liabilities. The Dingwall table shows this figure as U.S. $540,000. It's like, if they sold everything and paid off all debts, what would be left?
And that net assets figure, U.S. $540,000, ties directly back to the last section, the capital or equity part.
Absolutely perfectly. That final section, often called shareholders' equity or capital employed, shows exactly how those net assets are funded by the owners. It must equal the net assets figure.
So what makes up Dingwall's equity?
Well, the table lists share capital, the original investment by owners, at U.S. $100,000. Then retained profits kept in the business over time, a big chunk at U.S. $395,000. And other reserves, maybe things like asset revaluations, at U.S. $45,000.
And let me guess, $100,000 plus $395,000 plus $45,000.
Comes out to U.S. $540,000.
Exactly the same as the net assets figure.
It has to be. So the statement confirms that key identity. Net assets to shareholders' equity, capital employed, all U.S. $540,000 for Dingwall. This section really shows the owner's stake in the whole thing.
Okay, phew. That's the structure. Assets, liabilities, equity, all balancing out. Now, the important part, interpreting it. What does this snapshot actually tell us about Dingwall, or any business?
Right. This is where it gets really useful. It's not just a list of numbers. It's a diagnostic tool. It lets you analyze the business's financial state, its structure, right at that moment.
So you can look at the big numbers first, total assets versus total liabilities, how much owner money is in there.
Yeah, get the overall scale. Then you dig deeper, look at the asset structure. For Dingwall, U.S. $440,000 in non-current assets versus U.S. $284,000 in current assets. What do they tell you?
Well, it looks like they have quite a lot tied up in long-term things, like property, more than in short-term stuff like stock and cash.
Exactly. Which, as we said, makes sense for a building supplier. They need premises, maybe delivery trucks, that kind of thing. A software company, though, might have hardly any non-current assets, but lots of cash or receivables. The mix tells you about the business type.
And what about the other side? The capital structure, how it's funded.
Also very revealing. Dingwall's total liabilities are, U.S. $248,000 current, plus U.S. $60,000 non-current. So U.S. $308,000 total debt. Compare that to the shareholders' equity of U.S. $540,000.
So more money has come from the owners than from borrowing.
Right. This means it's less geared or leveraged. Relying heavily on debt liabilities can boost owner profits if things go well, but it's riskier because you have to make those debt payments. Dingwall seems relatively less risky in its funding structure here.
Okay, that makes sense. Now, you mentioned liquidity earlier with current assets. There's a key figure related to that, isn't there? Working capital.
Yes. Also known as net current assets. Crucial figure. You calculate it as current assets minus current liabilities.
So for Dingwall, U.S. $284,000 in current assets minus U.S. $248,000 in current liabilities.
Gives you U.S. $36,000.
Yeah.
Now, just a note, the source table itself might present a pre-calculated working capital figure differently in its layout, sometimes causing confusion, but the basic calculation for the itemized parts here is CA minus CL, so U.S. $36,000.
Okay, U.S. $36,000. Why is that number so important? What does working capital tell us?
It's a primary measure of liquidity, short-term financial health. Does the business have enough easily accessible resources, the current assets, to cover its immediate debts, the current liabilities?
And a positive number, like US $36,000, is good.
Generally, yes. It suggests they have a buffer. They should be able to pay their suppliers, their short-term loans, taxes due soon, using their current assets.
And if it was negative, if current liabilities were more than current assets?
That's a red flag. Big warning sign. It means they might struggle to pay bills as they fall due. Could lead to serious cash flow problems, even if the business looks profitable overall. So watching working capital is vital.
Okay, so working capital gives a raw number, but you can analyze these figures using ratios too, right, to get more comparative insights?
Absolutely. Ratios are really powerful for interpretation. A common one for liquidity is the current ratio.
How's that worked out?
Simple. Current assets divided by current liabilities. For Dingwall, that's US $284,000 divided by US $248,000.
Okay, let me grab a calculator. About 1.15.
Right. So roughly, for every US $1 of debt due in the next year, Dingwall has US $1.15 of assets expected to turn into cash within the year. Generally, a ratio above 1 is seen as reasonably healthy. It suggests they can cover their short-term debts.
Is there a tougher test of liquidity?
There is. It's called the acid test ratio, sometimes the quick ratio. This one is a bit stricter.
How so?
It acknowledges that inventories, stock, might not actually sell very quickly. You might have to discount it heavily to shift it fast in an emergency. So the acid test takes inventories out of the current assets before dividing by current liabilities.
Okay, so for Dingwall, it would be current assets, inventories, current liabilities.
Exactly. So US $284,000 minus the US $150,000 inventory divided by US $248,000. That's US $134,000. That's US $134,000 divided by US $248,000.
Okay. Calculator again. That's about 0.54.
Right. Significantly lower, less than 1.
What does that suggest? Is that bad?
It suggests that if you ignore their stock, Dingwall's most liquid assets, the cash and receivables, don't fully cover their immediate debts. Now, for a business like a building supplier that holds a lot of stock, this might be normal. It just highlights how much they rely on actually selling that stock to pay their bills. An acid test below 1 definitely warrants a closer look, though.
So these ratios give a more nuanced picture than just the working capital figure. What about the capital structure we talked about, the debt versus equity? Is there a ratio for that?
Yep. A common one is the debt-to-equity ratio. It measures the balance between borrowing and owner funding.
And that's calculated how?
Total liabilities divided by shareholders' equity. So for Dingwall, it's their total debt of US $308,000 divided by their equity of US $540,000.
Okay, 308 divided by 540 gives about 0.57.
So roughly, for every US $1 the owners have invested equity, the business has borrowed about 57 cents debt.
That sounds relatively low.
It is generally considered quite moderate or low. It reinforces our earlier observation that Dingwall isn't heavily reliant on debt. Lower ratio usually means lower financial risk. A ratio significantly above 1 would indicate high gearing or leverage more debt than equity, which means higher risk, but also potential for higher returns for owners if things go well.
You could even look at assets, couldn't you? Like how much is tied up in those long-term, non-current assets?
Definitely. You could calculate something like a fixed asset ratio, non-current assets divided by total assets. For Dingwall, US $440,000 divided by, total assets are $440K plus $284K equals $724,000. So 440 divided by 724.
Comes out around 0.61 or 61%.
There you go. Over 60% of their total asset value is in those long-term, non-current assets. Confirms it's quite a capital-intensive operation, needing significant investment in property and fixtures.
So these ratios really help summarize things quickly.
They do. They let you compare a company to its competitors or track its own performance over time using standardized measures derived straight from this statement.
Okay, one last thing on interpretation. That net assets figure, US $540,000 for Dingwall, is that what the business is actually worth? Like if someone wanted to buy it?
Good question. That US $540,000 is the book value based on the assets and liabilities listed here. It's the accounting value of the owner's stake. But it's not necessarily the market value.
Why not?
Because the real value of a business often includes things not easily captured on the statement of financial position. Think about intangible assets, a strong brand reputation, loyal customers, skilled staff, maybe secret recipes or patents. This goodwill can make a business worth far more than just its physical assets minus debts, but it usually only appears on the statement if it was explicitly paid for when buying another company.
So the statement gives the financial bones the structure, but maybe not the full picture of market value.
Exactly. It's a crucial part of the picture. showing the tangible financial position and structure, but not always the whole story of what someone might pay.
Got it. Okay, we have covered a lot there. What the statement is, all its different parts, and how you can start to interpret it using things like working capital and ratios. It really is a dense document.
It is, but understanding it is so fundamental. Okay, ready to see how much is sunk in? How about that quick quiz?
Let's do it. Okay, listeners, pencils ready, or just think along. Question 1, focusing on asset types. Which of the following is an example of a non-current asset? Is it A, inventories, B, mortgage, C, property, or D, cash?
Think about what's used long-term.
Time's up. What's the answer?
It's C, property. Remember, non-current assets are used for more than a year. Inventories and cash are current assets. A mortgage is a non-current liability, something owed, not owned.
Right. Okay, question 2, testing that core equation. If a company's liabilities are US $2,399,000 and its assets are US $5,800,000, what is the value of capital? Is it a US $5,800,000, B US $3,401,000, C US $8,199,000, or D US $8,199,000?
Remember, assets, liabilities plus capital, so you need to rearrange that. Capital equals assets, liabilities.
Okay, pencils down.
The calculation is US $5,800,000 minus US $2,399,000, which equals US $3,401,000. So the answer is B.
Perfect. Last one, question 3 about interpretation. The working capital of a business is given by which of the following? A capital employed, B net assets, C non-current assets, or D net current assets?
We talked a lot about working capital as a measure of liquidity. How's it calculated again?
And the answer is?
Working capital is current assets minus current liabilities. Another name for that difference is net current assets. So the answer is D.
Fantastic. Hopefully you got those right at home or wherever you're listening. So let's just quickly wrap up this deep dive on the statement of financial position.
Okay. We established it's that crucial snapshot, a picture of financial health at one specific moment, showing assets what's owned, liabilities what's owed, and capital or equity the owner's stake.
We broke down assets and liabilities into current, short-term, and non-current, long-term, and we saw how it all balances with that key equation, assets, liabilities, plus capital.
And importantly, we looked beyond just the structure. We talked about interpreting it, looking at the asset mix, the capital structure, calculating working capital as a vital sign of liquidity.
And using ratios like the current ratio, acid test, and debt to equity to get quick, comparable insights into that financial health and structure.
It really is a foundational document for understanding any business financially.
Definitely. Okay, so here's a final thought for you to mull over. We've stressed this statement is just a snapshot, a single point in time. So think about this. How much more could you learn if you compared these statements for the same company over, say, 3 or 5 years?
What could tracking the changes in retained profit tell you? Or the level of debt? Or the balance between current and non-current assets shifting over time?
Exactly. Could that tell you a story about growth? Or maybe increasing risk? Or improving stability? What trends would you look for?
That comparison over time, looking for trends, that's often where the real analytical power comes in.
Something to think about. And remember, if you want to explore this topic further or find more resources on IGCSE business studies, head over to www.igcs-business.weebly.com.
We really hope this session has helped clarify the statement of financial position for you.
Thanks for joining us on the deep dive. Keep digging into those numbers.